I want to start by just giving 8 variables that I want to look at deeper, and these are in no particular order. But first off, I'm looking at the S&P 500 top 30. Like I mentioned before, I want to take those top 30 so I can understand how they're valued. Second, then, as I take the weight of those top 30, and then I apply $100,000 value to each as an example of investment portfolio. I also want to know what's the 5-year treasury. So 5 years and less, I'm understanding that because I want to know what the risk-free rate of return is. That kind of sets the base of our equity risk premium, and also can be the expected return in a safe, risk-free type of investment. Then I'm looking at the stage of the business cycle. I'm understanding what is the equity risk premium based upon the business cycle and other variables. I then calculate my intrinsic value of those 30 stocks. I set my bands. What I mean by setting bands is you may not want to have, like, I can go 100% stock or 100% bonds. It might be the most I'll ever have in stock is 90, and the most I'll ever have in bonds is 30 for long-term investments. So it can be a preference, but you want to set some sort of bands that keep disciplined. And then you look at historically the last 7 years of business cycles might be. I always like to look at those business cycles to understand how does this, where we're sitting in this one versus where we're sitting in other ones. And it would look maybe something like this. So say I'm trying to make a forecast, and the stock, or I should say the companies, are expected to grow by 7.5%, whereas bonds, the risk-free might be 3.15%. And I'm using that $100,000 example, where we're at $100,000 of value, but in a market that the stocks are overvalued, the fair value is really only 81. So meaning that if the stocks went back to their intrinsic value today, you wouldn't have $100,000, you would have $81,000. But I want to understand, because we don't know when that's going to converge. We're using a simple rule that stocks have 2 forms of return: the return on the growth of the company, and then the conversion back to intrinsic value, which I've got other videos on. But we don't know where we're going to turn, but I want to see, all right, how long does it have to take before that $81,000 at 7.5% growth is going to equal the $100,000 at 3.5%, which is the risk-free. And it kind of converges at $121,000 because the 81's growing faster, and that would be in about 5 years. It's a little over 5 years. And now why is that important? That means that any time during that 5-year period of time, we had a convergence back into intrinsic value, and all those numbers stayed flat, the bonds would have been a higher forecasted value. It's important to understand the timing, and why I'm looking at timing is if I'm looking at previous business cycles, from where we are today to other business cycles, the average to converge to intrinsic value is about 1.79 years. So 5 years is pretty, I would say, conservative speaking, meaning will it converge in the next 5 years? Probably consider the average. There's never been a business cycle that has in the last 7 years. I think the most is 2.6 years it's taken to converge. So now if we're in this case, we may want to use, say, a 75-25, because we're going to want to hold some bonds, being that bonds will actually outperform stock if we have a convergence in the next 5 years. So that would say, yeah, we should hold some bonds. Now, if this number was 100, then of course this would be better, and we probably want to be more in stock. Now let's say that this number was like 70, and it's going to be 7 or 8 years before they converge. Very high likelihood that's going to converge. That means we want to have more bonds. We might move to a 64. So it's going to look like something like that when we're putting all the variables together, try to determine, does it make sense to hold bonds now? And if so, how much should we be holding in bonds versus stock?